You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thank you once again.
People keep asking, when is the big drop going to happen to the markets? You've been concerned for some time. Maybe explain why.
Well, there's a lot of people seeing the problems with the economy, the problems with the stock market, and there's even, I've been reading stuff from now foreign sources where it seems to be common knowledge. The situation that the market is in, the situation that the economy in is, and really even the global economy, and the powder keg that we're really on, and so it's like the story's getting out, if you will. But I've been saying this for years based on technicals, and what I'd like to do is back up just a little bit for the benefit of newer listeners and talk about some of this big picture stuff and why from a technical perspective. And if we could, let's go in doing that. Let's go back to I have to go back to the 2000 top, because that's where it all began. We had the natural secular bull market top, the secular bull market that ran from 74. The secular low did not occur in 82; it occurred in 74. Richard Russell used Dow theory to call that low weeks after the low. I've seen it. I've got his old material in print where he called it, and he was exactly right. Beautiful call. The bottom in the beginning of the secular bull market ran from 74 to 2000, and in 2000, that is the point in which the economy peaked, and the measures of that are real simple. I don't care how complicated someone tries to make an issue with fancy statistics or some twisted logic or something. It's just it's real simple. The economy quit expanding in 2000 along with the stock market top, because that's where it actually in 97 we saw the velocity of money peak, and since then it has turned down. We had a small divergence. It peaked in 97, and we had a small divergence with the top in 99, 2000, and that little non-confirmation divergence, if you will, that signified or coincided with the secular top in 2000. Well, I don't care how you try to twist it and explain it away. If the velocity of money, if the dollar is not changing hands, the economy has peaked. If the velocity of money is going down, and I'm not spending my dollar and you're not spending your dollar, the economy has peaked. That's black and white. No argument, no way to explain that away. And then when we look at the labor, and I've talked about this before, when you look at the labor force data, it peaked back in 2000 and has since declined to back to the 1977-78 levels. And so that coincides basically within a year or two of the velocity of money peak. And so again, I have to pose the question, how do you have an expanding economy and a secular bull market with the velocity of money collapsing and the labor force data declining and back at levels from, to the night, not seen since the 70s? You don't. It's real simple. You don't. And so that is what the central bankers have been fighting ever since 2000. They've tried to stimulate that. They've tried to stimulate the spending. They've tried to stimulate the velocity of money. I mean, it's real simple. And in doing so, they tried to stimulate jobs to get the economy going. But that hasn't happened. And what if you also just turn to the chart now of the Dow Jones Industrial Average, and you look at the traditional volume characteristics, what you see in a secular bull market is when the market is going up, as in the 80s and in the 90s, you see volume moves with price. as price expands, you have expanding volume, people coming into the market, and they're like, oh my God, this is going up, and the market grows and builds. It's healthy. The volume confirms the trend, if you will, with participation. That's what it's showing us, is that volume is expanding with price. Well, and then when the market declines, even during the 87 decline, the volume went down. And then as we came out of that, volume was a little light for a year or so in there, and that was a little iffy, granted. But the volume characteristics overall were positive. And then as we came out of the 87 low, 87, 88, the volume started expanding again, and the volume characteristics of the market were still bullish. It told us, when I say bullish, that we were operating within the context of a secular bull market. And then we had the 4-year cycle top in 1998, for example. There was a non-confirmation. In other words, price went up, volume went down a little bit. That was the warning of the 4-year cycle top. We rolled over into that 98 low, but guess what? When we came out of that low, volume expanded. Everything was good, and the price obviously moved higher. But again, if you're looking at the volume characteristics, once we saw the 2000 top and we declined into the 2002 4-year cycle low, there's a number of things that happened there. And one is, as we declined into that low, volume started expanding. It's like the mirror image. It's the reverse of what should have happened if we had still been in a secular bull market. And when I say secular, I'm talking not the fact that, well, let me just leave that alone for a minute. When you look at then as price moved up and out of the 2002 low, volume contracted, and then as we moved into the 2007 low, volume expanded, and now this rally has occurred on the lightest volume yet. And like I'm saying, it's a mirror image or reverse image of what should be going on, or what did go on, I should say, during the secular bull market. Those volume characteristics are telling us clearly that this is a secular bear market. Now, what I started to say a while ago is, secular bull and bear markets are not born of price. They're born of the underlying technicals, and the thing that has this economic situation camouflaged here, is the fact that they've been able to extend the cycle, the fact that they've been able to push this market to a new high, the fact that they've been able to print the money that they've printed, and while on the one hand the stimulus has failed and the velocity of money has continued to decline and the job participation rate has continued to be in the gutter, they've managed to create a housing bubble. They've managed to create a banking crisis, managed to push commodities higher, and create inflation there. What they're fighting, by the way, since the 2000 top, is deflation. It's deflation. The economy, everything's trying to deflate. They're trying to reinflate. So the inflation that we saw was a direct result of that stimulus to try to, get the thing going again. And in 2007, what they created, if you look at the unwinding, what was it all about? It was about the banking crisis. It was about the credit crisis. It was about the housing bubble. So all that came unraveled because there wasn't a sound secular bull market, if you will, underneath the price advance. It was all fake. It was all smoke and mirrors and not sustainable. And I said all during that period, I said, they're only making matters worse. They're only making matters worse. Well, now what has happened is we go over into the 2009 low. And what have we seen? More of the same that created the situation in the first place. And when I say in the first place, that we've seen more of the same that created the banking crisis and the housing bubble and the decline into the 2007 low, or excuse me, 2009 low out of the 2007 top. It's not sustainable. And yes, it's gone on much longer than I imagined, and most other people that have seen this. It seems like everybody's jumping on the bandwagon now because it's becoming so obvious. But the point that I was trying to make with all this background is I'm trying to say why, technically, we've been watching this since 2000, and there's no question that this is a secular bear market. There's no question that this has been going on, and there's no question why. And now, I admit, like I said, I am totally surprised that it has held up as long as it has under these conditions. They've done a masterful job at keeping it up and extending it. But this thing is running on fumes at this point. I don't know how much longer it can go. Maybe we've seen the top. Maybe it can go another few months. Maybe another. I don't know. The answer, I do know this. I will know it when I see it because of those DNA markers. And once they're all in place and the I's are dotted and T's are crossed, it's done. And the thing's going to go down. It's going to go down hard. And on that note, let me throw this statistic out. Another characteristic with the 2000 top is when you look at the secular bull and bear market periods, and the secular bull market periods, the 4-year cycle advances and then it rolls over and declines and it goes into the next 4-year cycle low. And the cycle, by the way, is measured from low to low. Since 1896, it's averaged 48 months. The reason we've seen the extension of the cycle, you can't negate the cycle, but you can extend the cycle. And the reason we saw the extension of the cycle between 2002 and into the 2007 top and down into the 2009 lows because of the outright blatant manipulation with the liquidity to try to save the market. Yes, it distorted the cycle. But that's what the DNA markers are about, to help us identify those tops so that we know what's going on. And just like now, we know that this is an extended cycle. It doesn't negate the cycle. Anyway, backing up, what I was going to say is that in every secular bull market, every 4-year cycle low holds above the previous low. Even in 1987, the decline in 1987, was amidst the secular bull market, that decline was into a 4-year cycle bottom, but it held above the previous 4-year cycle low. So that signature told us that we were still in a secular bull market. But then you fast forward to 2000, we had the 2000 top. Based on the setup, the DNA markers, and the statistics associated with that, and it's in print, in a magazine, I called that top and said that it would go below the 1998 low. And the reason I said it was because of the statistics surrounding the specific setup with the 4-year cycle. But when we shifted from the secular bull to the secular bear market, a characteristic of the secular bear market is that every decline into every 4-year cycle low has violated the previous 4-year cycle low. So the price action itself coming out of the 2000 top into the 2002 low confirmed that we had moved, or also confirmed that we had moved into a secular bear market period by the violation, or with the violation of the 1998 4-year cycle low. All right, fast forward. We get into the 2002 low, we rally, price makes a new high. How can we be in a secular bear market with price at a new high? But, and I, idiot me, I said based on all these same factors, I said we're going below the 2002 low. They've made matters worse, we're going below the 2002 low because we're in a secular bear market. And guess what? We did. We violated the 2002 low into the 2009 low. Well, guess what? They've extended this cycle. Volume has continued to shrink. Job participation rate is in the toilet. The velocity of money has not improved. All they've done is made matters worse. We're in a secular bear market, and guess what? When we see those DNA markers, when this sets up, they've made matters worse once again, and this time even worse because the statistic says we're going below the 09 low. It is going to collapse based on those statistics. That's what we're in for. And, I guess I've learned never say never, but until those statistics can prove to me that they're not going to play out, I have to stand by that statistic, because since the inception of the averages in 1896, that statistic has been valid. So maybe through the efforts of manipulation, they can negate that statistic. But until I see it, I'm saying that odds are 99.9% that when this thing cracks, it's going below the 09 low.
We'll have more with Tim Wood right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, the IMF has asked the U.S. Fed not to hike interest rates, at least until the first half of next year. Does that have any bearing on these statistics?
Well, I think I know what you're saying with that, and yes and no. I mean, this sounds discrediting in and of itself, but let me, you know, a lot of things sometimes are taken for granted that people, you know, they just run with it without researching the facts. And that is, the Fed may not have a choice. The Fed may not have a choice. There is, I have a spreadsheet and I have hard data. And, you know, people think that the Fed controls interest rates, and to some degree, yes, they do. Yes, they do. And they control it largely through the perception of the control, if you will. But the fact is, and I've overlaid the chart, and it's clear to see that the Fed actually follows the short-term T-bill 90-day T-bill rate. And I've overlaid the data. I've got a spreadsheet going back into the 40s. And what you see is that the market actually dictates rates. Market. And when the spread between the discount rate, the Fed funds rate, and the 90-day T-bill rate get too far out of hand one way or another, the Fed adjusts. Now, they will talk the market, they'll game the market by trying to control interest rates, you know, verbally, and so that they don't have to make those rate increases or decreases. And so what I'm saying is that when I say game, they're gaming the short-term interest rates, the 90-day T-bill rates. They're gaming the market, trying to tell investors where rates are going to go, what they're going to do. It's a perception. Everything's a perception. And I know that sounds discrediting, but I'm telling you, I have a spreadsheet, I have the data, and going back to the 40s with the one exception, one time, every Fed increase, decrease, with one exception, the market has dictated the hike or the cut. And so what we're seeing now is that the bond market is in trouble. A buddy of mine and I, one night, we watched as literally the foreign bond markets imploded. Some of the rates were up 1,000%. The thing just imploded. And we're watching this, and I'm thinking, oh my God, this. I mean, it was horrible. It gave me chills watching it. It was so bad. And somehow, some way, by morning, there was no sign of it. It recovered. And so what I'm saying is there is some tremendous problems with the bond markets around the world, and I think we're seeing signs of that. And so what I'm saying is if the bond markets start up, which they're trying to, or I say that, I mean, if bond prices start to implode, start down, and interest rates naturally start up, then the market, the Fed is not going to be able to game that, and they're going to have to do a rate increase. And I think what they're trying to do is talk the market into, well, I don't know how to say that. They're trying to game the market. They're trying to prevent the bond market from declining by that, you know, verbally, by gaming the market, if you will. But what I'm saying is if the market has its way, if the market does what the market's trying to do, then the market's going to force them into raising rates sooner rather than later. So I don't listen to them. I watch the charts.
Tim, anything else you wanted to add today?
No, I guess that's about it. You know, like I said, there's a lot of people that see or sense, it may even be a better word, because a lot of people are talking about the state of the economy and state of affairs, and they can't put their finger on it. They just, common sense, I guess, is just kind of prevailing. They feel it. And, you know, I'm saying these things, been saying these things based on the technicals and hard data. And, you know, it's amazing what you can see when you look at the facts. And, it's amazing. It's amazing to watch. And, I guess the only thing I'd say is if anyone wants, you know, the hard research to back this stuff up, you know, it's available in the newsletters. And I may do something this next month on the interest rates and show that. I know that may be also a hard concept to grasp, but, you know, I've seen two people. The last time I talked about interest rates really and brought up that point was, I think that was back probably in 2007 and 8 when we were seeing, you know, the interest rates being cut again. And Bob Prechter brought that up, that the market actually dictates rates. And I saw Mark Farber one time on Bloomberg mention that. So it is known. It's not known by many, but I may do something on that in the next letter. And the DNA markers are key. Once we get the setup, you can look at the shrinking volume, you can look at all this stuff, but structure and DNA markers are about structure. Until you get the structure to cap it, it can go on. So that's not me talking out of both sides of my mouth. It's saying we need the structure to cap it, and when that's done, it's done.
Tim, thanks a lot for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.